$200. Right now, 5 people are looking at that number. Same age, same projection on their screen. A chart showing what $200 a month becomes over 30 years at a historically average market return. The number at the end was large enough to stop the scroll, large enough to feel for a moment like a door opening. Same door, 5 different floors. Because here is what the chart doesn't show. The math of compounding is neutral. It doesn't know your name, your zip code, your employer, or your emergency fund balance. It runs the same calculation for everyone. But the conditions required for that math to run, those are not neutral. And conditions, it turns out, are everything. This is what happens to the same $200 in 5 different hands. The first person has 2 jobs and 0 buffer. Fixed costs eat 82 cents of every dollar they bring home. The $200 isn't discretionary. It's the difference between stable and not. They try anyway. They automate the transfer. Then the car breaks. $340 they don't have. The transfer stops. A medical copay arrives. Hours get cut. It stops again. It restarts. It stops. Over 10 years, they contribute roughly 7 months out of every 12. Behavioral economists call this the bandwidth tax of financial scarcity. When the present is a crisis, the cognitive resources that long-term planning needs get consumed by the immediate. It is documented. It is predictable. It is not a character flaw. At 30 years, the account holds $71,000. The projection promised $243,000. The gap between those two numbers is not laziness. It is the compounding cost of interruption. And interruption is what life looks like when your buffer is 0. Same math, different floor. The second person has room, not comfort, room. The difference matters. They automate the $200. They're inside the system. The transfer runs most months without drama. What they don't know, what nobody told them, is that the 401k their employer enrolled them in at onboarding is sitting in a fund charging a 1.1% annual fee. 1% sounds like almost nothing. Over 30 years, the difference between that and a Vanguard index fund at 0.04% is worth $94,000 in this specific account. Not in a worst-case scenario. In the baseline, they find out of 42. A colleague mentions it in passing over lunch. They move the account the same week. The 17 years of excess fees can't be recovered. You cannot earn back time, but the bleeding stops. A 2019 survey found that schools in high-income districts are 75% more likely to offer personal finance education than schools in low-income ones. The second person didn't attend a high-income district school. The information that would have saved them $94,000 existed. It was publicly available. It was simply never delivered to them because the systems that deliver financial guidance tend to deliver it most efficiently to the people already paying for it. At 30 years, $214,000. Same math, different floor. The third person sets up the transfer the same week they decide start. Roth IRA, Vanguard Index Fund, 0.04%. Automated, untouched. This didn't happen by accident. Their employer offers a financial planning benefit, a free annual consultation with an advisor who, in 45 minutes, explained fund selection, fee impact, and account structure. Those 45 minutes are worth, in this person's account, roughly $80,000 over 30 years. The benefit is available to employees above a certain salary threshold. They also have a 6-month emergency fund. In year 3, their partner took a pay cut and the apartment lease came up at the same time. They sat with the decision for a week. Do we pause a transfer? They moved to a cheaper apartment instead. The $200 kept running. That's the moment the emergency fund earns its name. Not by being spent, by making it possible to protect something else. The transfer never had to choose between the future and the present, because separate money existed to hold the present steady. That's the structural advantage no projection captures, the shield around the investment that lets compounding run without interruption, which is the only way it delivers its full result. At 30 years, $243,000. Exactly what the chart promised. Same math, better floor. At this level, $200 a month is not the unit of analysis. The conversation happens in different rooms, with different people, about different instruments entirely. The fourth person has a fee-only fiduciary advisor, legally required to act in their interest, not compensated by commissions. Annual retainer, $8,000. Annual tax savings from their advisor strategies, more than that. Last year, a Roth conversion ladder alone saved them $22,000 in future tax liability. The strategy took their advisor 3 hours to implement. Those 3 hours are worth more than most Americans earn in 6 months. They also have access to private equity, investment in companies before they go public. Historically, the highest returning asset class in American finance. Legally restricted to accredited investors, individuals earning over $200,000 annually or holding a net worth above $1 million. Designed as consumer protection. The practical effect: the best performing investments in the country are legally reserved for people who are already wealthy. The fourth person's investment income is taxed at 20%. Their executive assistant's salary is taxed at 22%. The tax code taxes money that makes money more favorably than it taxes work. That is not a loophole. It is the architecture. At 30 years, the outcome isn't a single account balance. It's a structure, multiple accounts, real estate equity, private holdings, and children who will grow up knowing what a Roth conversion ladder is before they ever hold their first paycheck. The inheritance isn't just money. It's fluency. And fluency compounds the same way capital does, in the same direction toward the same families across generations. Same math, entirely different floor. The fifth person cleans offices 3 nights a week, does day labor on the weekends, and has moved 4 times in 3 years. They earn real money for real work. But to open a brokerage account, you need a verifiable address, a bank account, and government documentation. Holding all 3 simultaneously, when your housing is unstable and your work is cash and your documentation has gaps. That combination is harder to maintain than it sounds from the outside. 5.9 million American households are unbanked. Another 18.7 million are underbanked, relying on check cashers, payday lenders, and money orders that charge up to 391% annualized interest. The fifth person's $200 doesn't compound. It gets extracted fee by fee, transaction by transaction, by a parallel financial economy that exists precisely because the formal one never reached them. At 30 years, 0, not a footnote, not an edge case, a wall built not for malice, but from a system designed around documentation, stability, and formal employment. None of those things were designed to exclude. The exclusion is what happened anyway. Same math. No floor at all. 5 people. Same $200. Same 30 years. Same math. Noble fare. Constant interruptions. $71,000. Consistent contributions. Wrong fund for 17 years. $214,000. Right fund, right information, emergency shield in place. $243,000. Professional guidance, tax efficiency, restricted asset access. Generational, structurally excluded from the start. 0. The question is who can hold the conditions compounding requires. And the answer runs along income lines that were not drawn by the market. They were drawn by policy. School funding tied to property taxes. Banking infrastructure that charged the most where it should have served the most. Accredited investor rules that legally reserved the highest returning assets for people who were already wealthy. Zoning laws that built the racial wealth gap in housing and called it development. The $200 decision is not a $200 decision. For one person, it becomes $243,000. For another, $71,000. For another, nothing at all. Not because of who they are, but because of where they are standing. Same math, different floors. One of those things can be changed.